Okay, guys, today we will do exam kit questions from risk and uncertainty. First, we will do question called ketone. We will do question called ketone. Before everything, believe me, question reading is a skill. How answering is a skill, like that. Question reading is a skill. You will see. First, you have to see what they are asking. Construct a payoff table that we know how to do. That payoff table, what and all values should it should have? It should have possible profit outcomes. When you consider a payoff table, inside that contribution should not be there, profit should be there. And recommend the level of production. What are the three levels of production? 3000, 3500, 4000. How much we have to produce based on expected value? This is a question, 13 marks. B and C will be easy. First, we will do this. What are they given? Very easy question. The company demand falls between 3000 and 4000 units, can be manufactured in batches of 500 units only. So, even if they don't give it below, we know they can manufacture between 3000 and 4000 in batches of 500. So, they can either manufacture 3000, 3500 and 4000. Okay. Therefore, ketone must decide whether they have to manufacture 3000, 3500 or 4000. Given the short shelf life, any units remaining unsold at the end of each month should be thrown away. Why they have given this? Because you will tell, you will come tomorrow and tell. If I manufacture 4000 today, it doesn't sell today, I'll keep it in the fridge and I'll sell it tomorrow. Like that you will tell. But it can't happen. If you manufacture today and if it doesn't sell off today, it is waste. Variable production cost of one unit is given to us 6.2, 2.7, 1.35. Okay. Protein powder, protein power will be processed in some machine. Machine is set up for a new batch of 500 units. It will be cleaned and inspected at a total cost of 240 units. What is this? What does it mean? We can call it a fixed cost. If we are manufacturing 3000, we can call it fixed cost. What is the other name we can give to it? We've done a question also. When fixed cost keeps on increasing, what do we call it? Step fixed cost. It looks like a step now. We saw now. Until one product will go like this. If it increases, it will increase and again go like this. That is why it's called a step fixed cost. It looks like a step. This is a step fixed cost. Fixed cost keeps on increasing after every 500 units. If we are producing every 500 units, what is the cost? 240. So, 1000 units means into 2. How we found out? 1000 as 2 500, 500, 500. 2000 as 4 500s. How do we find it? That amount, that units divided by 500 units. So, we have 3 production units. 3000, 3500 and 4000. Divided by 500, if you put how much you will get? 6, 7, 8. You have to change 6 times if you want to produce 3000 units. You have to change 7 times if you want to produce 3500 and 8 times if you want to produce 4000 units. Multiply by 240. What you are getting? Fixed cost for all units. Tell me. 1440. 1680. For 4000? 1000? Look at the question and tell me. What changes can we do? Correct only. One part, one small change we should do. What change we should do? Selling, I will come to that later. Tell me. Can we proceed? No change we need to do. Correct only. Tell. Just for you to read the question more thoroughly, I was telling what we are producing 4,000 units. What is the fixed cost? 4,500 into 8. How much? Sorry, 8 you'll get into 240. How much you'll get? 1,920. 3 fixed costs we got. We'll keep this as these are all related to production or sales. Think and tell. You're saying if you manufacture, you have to change the mission. These are all related to production. Okay. Next what is given to us? In addition to the above, it incurs a selling and distribution cost of 0.9 for every unit sold. Not every unit produced, every unit sold. So what we can do is, we can club this 0.9 rupees with our selling price. You club it with your selling price. If selling price is 35, make your selling price to 35 minus 0.9, 34.1. So selling price is 33, 33 minus 0.9, 32.1. Why? Only if you sell, we will incur this cost. So include with your selling price. Because selling price, you'll multiply the number of units sold. Cost, you'll multiply the number of units produced. You'll multiply this with the number of units produced. So what you should do is include it with the selling price. Understood? Right, I will do. Now one by one we will do. Before doing the payoff table, first we will create a payoff table and keep. What is heading you will do? Production or supply? Heading. Heading is production or supply? Heading is production or supply. Top column. Top row. Both are same. Both are same. Supply or production, both are same. How many units? 3,000, 3,500, 4,000. This column what you will put? Demand. Demand is how much? 3,000, 3,500 and 4,000. What are probabilities given to us? 0.2, 0.3, 0.3, 0.5. Okay, one by one we will do. One by one. Yes, yes. They give? That they will not give. If it's that long, you have to create a payoff table which is literally 500 columns. There are chances. Here it's an approximation or it's an estimation you are taking. Technically, what you're saying is right. So what if you produce 3,000 and the demand is 3,200 units? It can be, but here they're specifically given demand will also. If they don't give also, you should assume that it's the same as supply. Because if it's the other way around, in demand column, we have to write 3,000, 3,001, 3,002, 3,003, like that 3,004 till 4,000 we have to write. 1,000 rows you will have. Understood? Okay. First, we are producing 3,000 and selling 3,000. What is your selling price if you produce? Okay. They are saying up to 3,500 units, our selling price is 35. More than 3,500 units, the selling price is 33. First, let us change our selling price. Our new selling price is up to or equal to 3,000, less than 3,000 units, 3,500 units. Our selling price is 35 minus 0.9, that is 34.1. More than 3,500 units, our selling price is 32.1. 33 minus 0.9, 32.1. Why are we including selling and distribution with selling price? Listen, you can write later. Because selling price you will multiply by the selling units. Cost you will multiply by the production units. If you include the cost here, that cost you will technically multiply the production units, which you should not do. Selling cost you will incur only when you sell. So you have to multiply the selling cost with the selling number of units only. If you include it here, easy calculation, it will be better. Understood? Any doubts? Okay. Now, if we produce and sell 3,000 units, what is our sales we will get? Produce and sell 3,000 units means what are the sales we will get? 3,000 into 3,000 into 34.1.
Yes, sir.
1,02,300 minus what are the two costs we have? Variable cost, fixed cost. Variable cost, fixed cost we found out. Variable cost, how much we have? 6.2 plus 2.7 plus 1.35, how much you are getting? 10.25. So 10.3,000. Production also 3,000 units. 3,000 into 10.25, how much you are getting? 30,750. Then minus what are other costs? Fixed cost. This is production fixed cost is 1,440. 1,440. If you do this, what you are getting? 70,110. Sir, we didn't consider this, but we got the first column correctly, sir. How? Here, first column we got correctly. Here, second column we got correctly. Third, because in these columns, your production and supply are the same. You're producing 3,000, you're supplying 3,000. You're producing 3,000. Your demand is, even though it's 3,500, you can sell only 3,000. 3,000 and 3,000. So it's the same. There will not be any mistake. So for all three columns, 70,110. If we produce 3,500 units and sell 3,000 units, what we will get? So if we sell 3,000 units, what is the selling price? We earlier found out, no. 1,02,300. 1,02,300 is the selling sales price. Minus variable cost is how much? 3,500 into 10.25. How much are you getting? 35,875. Minus what is the fixed cost you are getting? Production 3,500. Always sales, number of units selling. Cost, number of units produced. How much we are producing? 1,680. We earlier found out. 1,680. How much are you getting? 65? 645. Second case, you are manufacturing 65, 645. Second case, we are manufacturing 3,500. We are manufacturing. We are selling also 3,500 units. In that case, what will happen? Sales alone. Sales is how much? 3,500 into 10.10 now. 34.1. 3,500 into 34.1 is how much? 1,19,350 minus production is same as above. Above you have found out 3,500 into something 35,875. Fixed cost also same 1,680. How much are you getting? 81,795. This will be the same for next also, because next we are producing 3,500. Demand is 4,000, so no change. Even though demand is 4,000, we can sell only 3,500 units. So 81,795. Next, we are producing 4,000. We are selling 3,000. Selling 3,000 means what is sales? Copy paste and write from above. 1,02,300. No. Because what? No. Here, even though we are producing so many units, we are selling only 3,000 units. No. Selling price is only for based on sales. Selling price 3,000 units means selling price per unit will be 34.1 only, not 32.1. So sales will be 3,000 into 32.1. That will be 1,02,300 minus variable cost will be 4,000 into 10.25. How much are you getting? 41,000 minus fixed cost will be production 4,000. Fixed cost will be 920. 1,920. How much are you getting? 59,380. All just go and copy paste it. Right. 51. 51,380. Yeah. 59,380. We are producing 4,000, selling 3,500 units means what will be your sales? 34.1 into 3,500, that is 1,19,350. Yeah. 1,19,350 minus variable cost is 4,000. Variable cost is 4,000 units. Copy paste from above. 41,000. Fixed cost also copy paste from above. Fixed cost and variable cost you can copy paste from the similar items. So 76, 430. 76, 430. Come above, right? 76, 430. Now tell me, production 4,000 units means how much you will get? This is the only place where sales will get affected. Because producing 4,000 and selling 4,000. So selling price will be 32.1 here. Sales will be 4,000 into 32.1. How much are you getting? 1,28,400 minus a variable cost is same. Copy paste from above. 41,000 minus fixed cost also copy paste from above. 1920. No? 1920. 1920. How much are you getting? 85. 480. Understood all of you. This payoff table you will do, they will give you 85, 480. This payoff table you do, they will give you 9 marks, 8 to 9 marks. What about other 4 marks? Other 4 marks is recommendation. You have to recommend based on expected values. Expected value, we did not question no. What did we do? We had some values, we multiplied by probability, we got probability into value, the total we got the expected value. Here we have three values, no, three columns of values. There we had one column of value, we multiplied, we found out. Here we have three columns of values, multiplied each. So this is where your probability will be used. Look, 20% into 70110, 30% into 70110, 50% into 70110. Add everything. What you are getting? 70110 only you will get. Because here everything is 70110.
Yes, sir.
Understood? Second, 20% into 65,645, 30% into 81,795 plus 50% into 81,795. You add everything, what you are getting? Do. A payoff table, right? 65,645, 78, 81,795. I really don't understand handwriting. 81,795, 81,795 over both. Okay, 65,645, 65, sorry, 64. No, for 33,500 units production and sales 3,000 units, what is the value you are getting? 64,745. They got 64,745. What mistake we did? 1,02,300. Okay. Minus variable cost is 3,500 into minus 1680. What mistake we did? 64,745 they got. Calculation mistake. 64,745. 64,745. Tell me what you are getting. 0.2 into 64,745, 0.3 into 81,795, 0.5 into 81,795. What are you getting? Fast. Round off, do whatever you tell me the answer. Use calculator. 7440. 64,745, 81,795, 81,795. 0.2 into 64,745, 0.3 into 81,795 plus 0.5 into 81,795. Or you can do 0.2 into 64,745 plus 0.8 into 81,795. 0.3 plus 0.5. Both also you can do. You can do it separately or you can add it and do also. What are you getting? 78,385. 78,385. Last one. 0.2 into 59,350, 0.3 into 79, 0.5 into 85,480, 59,380, 76,430, 85,480. What is the expected value you are getting? Fast. 77? 77, 5, 59,380, 77, 545. Try not to make silly mistakes. Now, even if you don't know concept, if you make a mistake and come, no problem. After knowing a concept, if you make mistake and come, okay, you can write later. Understood, all of you?
Yes, sir.
Listen, you can write later. All of you got the expected values, no?
Yes, sir.
Hello? Hello? Which expected value is highest out of the three? So if you produce 3,500 units, the expected value we are getting is more. What are they asking? Calculate the, recommend the level of production based on expected values. So expected value, this is more. Based on this, we will recommend 3,500 units. Understood? Now we are going to see a very, very, very important concept. Listen to me. Suppose, listen, very important concept. suppose God is coming, isn't it? God is coming and telling you, today I will tell you what to produce. Tomorrow I will tell you what to produce. Currently, what the demand is, God will come and tell you. How much will you pay God? That is the question. God is coming and asking you, you don't have to produce more, sell less, or produce less, sell more. That all is not required. I will give you one blessing. What you will, how much demand you will get daily, I will tell you. How much you will be ready to pay me? Like that, God is asking you. How much will you pay God? Logically, amount I don't want. Logically, you tell them how much you will be ready to pay God. Huh? 50%. No, are you doing business with God? That's the problem. God only asks information. God doesn't have money. How much will you be ready to pay God? And if you do, some loss might happen. You might produce more, no one will come and buy. God is coming. I will tell you how much to produce. Currently, the demand will come for that day. Like that, God is telling. In that case, how much will you be ready to pay God? Because of that, how much extra you will get, that amount will you be ready to pay God now. Because of God telling you that information, you will obviously get some extra profit. Okay, if God didn't give you any information, how much units you will produce? 3,500. Because 3,500 expected value is more. 78,385. If God didn't tell you anything, you would get an expected value of 78,385. If God gives you the information, what will be your expected value? Higher, definitely higher. How much? Oh, difference amount. That is how much you will be ready to pay God. But how much profit you will get? If God, tell. If God tells you na, if you produce 3,000, you will sell 3,000. If you produce 3,000, if you sell 3,000, how much you will get? 70,110. I will write that. God tells you now, if you produce 3,500 units, you will sell 3,500 units. In that, how much you will get? 81,795. If God tells you now, if you produce 4,000, you will sell 4,000. How much you will get? 480. What is the expected probability of everything? 0.2, 0.3, 0.5. With that values, you multiply and tell me how much expected value you are getting with the information. 0.2 into 70,110. 0.3 into this, 0.5 into this. I think if God tells us, diagonally you will get 33,000, 3,000, 3,500, 3,500, 4,000, 4,000. How much are you getting? 1 lakh? 37,000. No. 81,301. Understood how we got 81,301 now? What happened? Understood? If you produce 3,000 and sell 3,000, how much you will get? If you produce 3,500, sell 3,500, how much you will get? If you produce 4,000, sell 4,000, how much you will get? That multiply by respect to probability, you will get how much? You got how much? 81,000. If God didn't give information, how much you would have produced? You would have produced 3,500 units only, and you would have got an expected value of 78,385. Because of God telling you how much you are getting? 81,301. Because of God telling you that information, how much extra profit you are getting? 81,301 minus 78,385. How much are you getting? 2,916. This is extra profit because of God giving you that information. This is how much you'll be ready to pay for that information. That information is called, isn't it? Right later. The information is called as perfect information. And information is called as perfect information. How much you'll be ready to pay if someone gives you exactly the perfect information. I will be ready to pay extra 2,916. If I pay 2,917, I'll get 1 rupee less because of that. So exactly maximum I will be ready to pay for the perfect information is 2,916. If some insurance guy is coming and telling me, Daily I'll tell you what to produce. How much you'll give me? I can tell him. I will give you 2916. I think you'll tell him. Understood? This is called as value of perfect information. That is what they are asking in the second. Calculate the maximum fee which ketone company would be prepared to pay the market research company for the information about actual demand levels. Some information company is there. He will tell actual demand how much will be there. If he tells actual demand, we will be ready to pay him 2,916. That's the maximum amount. They have clearly asked what is the maximum amount you will be ready to pay him. In exam, if they give this question and ask an MCQ, they will ask equal to 2916, more than 2916, less than or equal to 2916, less than 2916. Which option will you choose? Again, I will tell. Exam, if they give an MCQ, they will ask you 4 options: more than 2916, less than 2916, less than or equal to 2916, equal to 2916. Less than or equal to. You'll be ready to pay maximum 2916 or less than also beneficial to us. Understood? This is what it is all about. Yes or no? That is what they are asking second part. If you write this, you will get 3 marks. So technically now we got 13 plus 3, 16 marks. Are you confident about this question now? Third, wait. You can write later. Briefly discuss whether, I'll give you time to write after this question. Discuss whether it is appropriate for the managing director to use expected values as the basis for decision making about the production level of protein powder. They are saying if we use expected value method, what kind of methods we saw in this chapter, this concept? Expect values, no, in this concept alone, payoff table concept alone. Expect values we can use and find out. Maximax we can use and find out. Minimax we can use and find out. Maximum we can use and find out. They are asking whether it is appropriate for the managing director to use expected value as the basis for decision making. Whether we can do this or not. Think and tell. They told it's not accurate. Where they told it's not accurate? Where they told it's not accurate? They told if we take the marketing research company, we'll get accurate information.
Okay. Sir, but then we have that staff value, sir. We have no staff value.
Okay.
So we use minimax, we can produce a minimum and we use it.
But minimax, they keep saying that I am a risk averse person.
Yes.
Only
Yes,
where?
the managing director is very risk averse.
It's considered that the probability no doubt may not be accurate. That probably you can write. First, it's appropriate for him to use now. First, you have to write expected value. You can use only on long term. How will you get probability? Based on what we've done in the past only, we will get probabilities. So if we've done lot of business in the past, if you have a long time doing this business, then we can use expected value method. The question in this case, it will be they've asked for alternate decision. They've asked for alternate decision. Alternate decision way as a manager is a risk averse person, it is better to use maximum. Maximum of the minimum. First find the minimum of every product in that maximum. So minimum I will get. So as a manager risk averse person, I can use maximum approach. Just explain this in detail, you will get. What? Better to do. Technically not required. They just ask to discuss which is required. As a risk averse person, it's better to use maximum. We can write like that. But it's better to do the practical question also. Maximum will take maximum 1 minute over. Understood. This is how this question should be approached. Minimax regret. That also mostly risk averse person. That also regret only. Minimax is whether you choose the maximum regret or minimum regret. Ask the question. Minimum regret. You want to regret minimum or you want to regret more?
Minimum regret.
So what you will find in every product, you will find how much maximum we will regret. If you produce 3,000, we will regret this much. If you produce 3,500, we will regret this much. If you produce 4,000, we will regret this much. Maximum regret you found out. In that minimum we will choose. I want to regret less as possible.
That is minimax.
That is minimax regret table. Yes, minimax regret. Yes. That also discovers only. Yes. Maximum risk taking person. Maximum. In this question, If they give Maximax, which approach will you choose? Which products will you choose? Maximum. 4,000. With 4,000 to 4,000, 4,000 units.
Yes, yes.
Maximax 4,000 units I will produce. Always, what we have to choose is only in our hands. How much demand is not in our hands. Maximum, minimum of everything you take 3,000. Because 3,000 only you get 7110. 3,000 you get 7110. 3,500 you get 64 something. 4,000 you get 59 something. Maximum of the minimum is 70,110. So maximum you will choose 70,110. That is 3,000 units. Understood all of you? If you write a question like this, you will get 20 marks.
So, but this is based on profit only, right? But previously we did based on profit.
Contribution, no problem.
So, based on profit also we can do the max.
You can do based on anything. Payoff table, on what basis it should be created, they'll give you the question. Whether based on contribution or profit will be given the question. Based on you find out which you need to do. Understood this question? Such company is considering changing some of the vans to it uses to transport crates. The new vans come in 3 sizes: small, medium, and large. They don't know which type of van to buy. Small vans. Small vans has a capacity of 100, big medium van 150, and large van 200. Demand for the crates can either be 120 or 190, with the probability of the higher demand being 0.6. 0.4 for other. What higher demand means? 190. More demand. I'll tell you. We have to see cost though, because if you, I'll tell you. We'll read the question. I'll tell you. So with this, what you can analyze is our production or capacity or whatever is 100, 150, 200. Our demand is 120 or 190. Why we are buying 100 crates vans? Anyways, minimum is 120 now. If I buy 150 and if demand is 120, 30 space is empty, it's going no. Because of you may lose something. We'll see what they've given in the question. The sale price per crate is 10, variable cost per crate is 4. Subject to the fact that if the capacity of the van is greater than the demand for crates in a period, you're saying if capacity is more than demand, 200 capacity, demand is only 120. In that, like that is I say it's again, the cost will be 10% lower. Variable cost will be 10% lower. Okay. As such is concerned that if the demand for the crates exceeds the capacity, then the customers will have to be turned away. Because of that, we will lose a goodwill of 100 rupees. Again, 100 rupees will not lose anything. They just estimated some amount. Every customer we go out, our brand's value will get reduced by $100 like that they've given. Okay. Then depreciation charge should be 200 for small van, 300 for medium van, and 400 for large van. Here, if you see, if you get large van, depreciation is 400. If you get small van, depreciation is 200. Difference is there no. This way I use small. This way I buy small van. Compare the cost and we will see. This is why I buy small van. If I buy big van, I have to depreciation every year. $400 is happening. Small van and depreciation of only 200 vans is happening. Understood all of you? Yes or no?
Yes.
Assets have been very aggressive in decision making. That means which one you will use? Aggressive in decision making, pressing with the rapid growth changes. Our managers have recently grown more cautious as the business has become more competitive. We will see. First, explain the principles behind Maximax, Maximin, and expected value that are used in decision making in uncertain situations. Write about Maximax, Maximin, and expected value. Maximax, someone who is more risk taking, he wants to get the maximum profit. He'll take efforts to get that maximum profit. Maximin, someone who's a risk averse person who's not ready to take risk. He will use Maximin approach. He will take the minimum risk of everything and then we'll find the maximum. That's right on your own. They're only asking explain the principles. They're not asking you to do numericals. Expected value, someone who's risk neutral, use expected value. Like that, write about all the 3 points, you'll get 5 marks. Very easy. Everyone will get 5 marks in this. They'll give 5 marks to everyone in this. Prepare a profit table showing 6 possible profit figures. Profit table is nothing but your payoff table. Profit table is nothing but your payoff table. Wait, I will do and then I'll give you time to do. Okay. First, what will be my supply levels or capacity levels above? We will write as supply 100, 150, 200. What is the probability here? What are the three? Oh, what are the demand levels? 120, 190. Probability 0.6 for the highest demand. Highest demand is 190 is highest demand. Our other will be 0.4. Both should be probability. All addition of all probability should be equal to 1. We will go one by one. If we produce 100 and our capacity is 100 and the demand is, we can write later. Our capacity is 100, our demand is 120. In that case, what is this? How much can we satisfy? 100 only. We can give more. And the capacity is 100. One product, how much you will get? 10. Variable cost is 4. So 10 into 100, you will get 1000. This is your sales. Minus variable cost is 4 into 100, 400. They have told if capacity is more than demand only, we will get the lower variable cost. Here capacity is less than the demand. Yes. If we return some customers, are we returning some customers? Then what will happen? 100 rupees goodwill we will lose, irrespective of number of units. So minus 100 rupees goodwill we will lose. Any other thing is given to us? This is small one or big one? 100 is small one. Depreciation is how much? 200. These are the three costs we will incur. 1000 minus 400 minus 100 minus 200 is 300. 300 is your first payoff table answer. Profit we will get. Second, 100 and 190. The capacity is 100, demand is 190. In this case, what will happen? Same, no change will be there. 100 sale, 100 variable cost, depreciation 200, customer going away, goodwill losses 100, same. So 300. Capacity is 150, only 120 customers came. In that case, what will be a sale? Sales will be 120 into 1200. Variable cost will be 120 into 120 into 120 into 3.6. How much you will get? 432 will variable cost, because 10% we will save. Capacity is more than demand, 10% we will save. Next, medium or small one? Medium one means depreciation is 300. Any other cost we have? Are we showing away any customers? No. So 1200 minus 432 minus 300 you will get 468. 150 capacity, demand is 190. In that case, what will happen? 150 into 10, 1500. 150 into 4. 150 into 4 is 600. Depreciation small one is goodwill. How much are you using? Whatever it is, 100 rupees only. Whatever it is, 100 rupees only. 100 rupees is goodwill. Medium and means depreciation is 200, 300. So 1500 minus 600 minus 1000 minus 300 is 500. 200 capacity, only 120 people are coming. 120 only will get sale. 120 into 10, 1200. Capacity is a 3.6. 120 into, they already calculated, no, 432. Same thing only will come. Big one, small one, medium one. So huge depreciation of how much? 400. So 1200 minus 432 minus 400, how much you are getting? How much you are getting? 368. Capacity is 200. Customers are only 190. In that case, what will happen? 1000?
Capacity is 200, but the demand is 190. Sales will be 190. And the variable cost
1190 into 1900. Variable cost will be 190 into Capacity is more. So 3.6. 193.6. How much are you getting? 684. And then depreciation is 400. How much are you getting? 816. This is what they are asking. Prepare a profit table showing 6 possible profit figures. Nothing more they are asking. This is what they are asking. Understood, all of you? Using a profit table from above. C. Okay. Using a profit table from above, discuss which type of van SH should buy, taking into consideration the possible risk attitude of managers. Tell. Possible risk attitudes of managers. Different attitudes are there. Max, how much you will get? One letter changes huge. Risk attitudes of managers. One manager is covers person, one manager is aggressive person. Aggressive means max. One is neutral. Neutral means expected value. Neutral means expected value. Expected value. Hours means maximum. Minimax. One do maximum. Minimax unless they have don't do. No maximum. Exam will get confused. Minimax unless they have don't do. Do maximum only. Understood, all of you? How to do minimax? You wait. You tell. Risk taking person means what you will do. Risk taking person means what will you choose? Max. Maximum risk is ready to take. Maximum profit only you will want. Max. Risk hours person means maximum, because he is seeing in this minimum I will get this profit. In this minimum I will get this profit. In this minimum I will get this profit. So minimum is guaranteed. Out of the whichever highest I will choose. That is maximum. Expected value is risk neutral. These three methods. Find out. They are asking using profit table, which they should be taken in consideration. Write out about 3 methods. How much you get from 3 methods based on what you choose, right? Because they are asking this for 6 marks. If you do this, you will get 20 marks. Understood, all of you? Just 1 second. All 3. Very easy. Maximum is easy. Maximax, nothing. Expected value for all 3 you write. And if they ask perfect information, you write. They didn't ask. Discuss. Come down. No, they have given one more question below. Discuss 3 methods other than those mentioned in A, which businesses can use to analyze and assess the risk that exists in decision making. What and all we can use? What are the methods we saw? Sensitivity analysis, simulation, expert value. It's not given now. It's given. Expert value is given. Minimax regret. And I told starting some theory is there now. That will also come here. Understood? So no. Oh, that is what is there in this question. How do it? But before doing, I'll just complete one more small thing from your notes. Come to risk and uncertainty. Okay, come to your this thing now. Your book, page number 302. You can do this. I'll give you time to do. We'll first finish this. Come to our payoff table question. Our payoff table. We did one question of payoff table. Come to the payoff table. So if you see in the payoff table, all of you got the payoff table? If you see in the payoff table, look at that and tell me if there is no perfect information, which product will you choose? If there is no perfect information, based on expected values, you have to find for each production or each demand. Each production or each demand? Each production or each demand? Production. We did know 0.2 into this, 0.3 into this, 0.4 into this, into production only. For each production, if you produce 40 expected value, everything from the side of production only. Only minimax regret to find the table you use demand. Other than that, everything from the side of production only. So if you use 40 salads, what is the expected value? 50 salads, what is the expected value? 60 salads, what is the expected value? 70 salads, what is the expected value? Tell me what is the expected value in all the 4 cases? 0.1 into 80, 0.2 into 80, 0.4 into 80, 0.3 into 80. If you do, you will get 80. So first you don't have to do anything. Second case, 0.1 into 0. Directly you can do 0.9 into 100.
Yes, sir.
You can add all and do 0.90. Third, 0.1 into 8, 0.2 into 20. You will get 4 8 minus 4 minus 4 7 0.7 into 12.
48.
Whatever. Tell me what is the expected value. 0.1 into minus 80, 0.2 into 20, 0.4 into 120, 0.3 into 120, 80. Okay. For 70 salads, 0.1 into minus 160, 0.2 into minus 60, 0.4 into 40, 0.3 into 140. How much are you getting? $90. Okay, now we got 80, 98, 80, 98. So 80, 90, 80, 98. Out of these 4, which one will you produce? Based on expected values, I'll produce 70 salads. If I have perfect information, what is the respective profits I will get? 40, 40 I will get 80, 50, 50 I will get 100, 60, 60 I will get 120, 70, 70 I will get 140. Probabilities are 0.1, 0.2, 0.3, 0.4. Multiply what are you getting? 8, 20, 36, 28. What are you getting? 92.
48, 42.
What's 48? Did I do any mistake somewhere?
120.
Oh, 0.4. I wrote it wrong. 0.03. I wrote it wrong. 48 plus 42. I wrote it wrong. 118 we got. So if God comes and gives us the perfect information, we are getting 118 profit. Without that, how much we have to produce? We have produced 70 and we have got a expected profit of 98. How much extra we will be ready to pay him? 20 will be the perfect information. Value of I'll check once. I'll check once again. Value of perfect information will be some mistake you guys did. 0, 90, 80 and 30. For last one it's 30. How you got 98? I also didn't see. What? Into what into 70?
140 into 30%.
Okay. 40 into 40%. No, not using perfect information. Without perfect information. For 70 salads, what is the expected value?
160 into 10%.
Minus 160, minus 16,
Yes, sir.
minus
6.
minus 6,
12.
minus
12.
12,
That is minus 28, sir.
minus 16, minus 12, minus 16, minus 12 is minus 28, 16 plus 32, how much are you getting? 48, there you got 58, there you got 28, 30 only you got, who got 98? 30 only you got. So we will just what? We will supply only 50 salads and expected profit you are getting 90.
Yes, sir.
With information we are getting 118. 118 minus 90 you are getting 20. You will be ready to pay 28 rupees extra for that perfect information. Understood all of you? Yes or no? This is what is there with. In this chapter we have more decision making. So decision tree. Decision tree we will have. Next class we will complete decision tree and we will complete theory also in the next class. We will complete decision tree, we will complete theory, and then we will proceed to next most easiest chapter called pricing.